If I had the information I'm about to share in this video before I started trading crypto and altcoins, I would be worth 5, 10, maybe even 20 times what I am right now. But when I started, no one was sharing this information for free. That's why I've put together this course so people can have the advantage that I never had. Trading crypto, the basics and beyond. This video dives into specific information that I wish I had when I first started out my crypto journey, and I would have done so much better if I knew this stuff. It took me years to learn, but I'm going to give beginners the advantage I never had. This lesson is going to cover market participants. Who are they? Why do they matter? Key cryptocurrencies. Which ones do we need to know, and what do we need to know about them? The money flow cycle in crypto. How assets tend to move on a macro level in crypto. Key terminology you need to be aware of, and a quick word on supply and demand. Please take a moment to read this disclaimer. In the previous lessons, we've gone over how a trade works. Now we're going to reinforce the definitions and go over it with a specific example. What are key components of a trade? A trade always has to have a buyer. This is someone purchasing an asset, something like Bitcoin or Ethereum. A seller is someone offering an asset. Now this is someone offering Bitcoin or Ethereum. Next, we have the broker. The broker is the person who facilitates this buying and selling. Now let's use a real example. An example of a broker in crypto is FTX. This is the one I personally use, and don't worry, I will have future videos explaining everything about this platform, how to use it, and how to trade on it. But for the context of this video, they're just going to be an example of a broker. They allow us to buy and trade crypto in exchange for a small fee. If we open this tab over here, we can see multiple cryptocurrencies that you can trade. If we take this over here, Bitcoin USD, you can see that there is a lot of buying and selling going on. Over here under the tab market trades are currently trades that are happening. The red ones are selling that's occurring, and the green ones are buying that's occurring. Over here on the green side, you can see loads of market participants ready to buy, and on the red side, you can see lots of market participants ready to sell. This is the broker. This is them facilitating the buying and selling. You'll see throughout this course, every piece of information is carefully selected to continually expand your understanding of trading and the market as a whole. The next key concept we're going to explore is market capitalization. A market cap, in the context of the crypto markets, is the token price multiplied by the number of tokens. We're going to explore another essential platform. FTX will explain in more detail later. Right now, I want to introduce CoinMarketCap, another great platform. It's completely free and it has so much useful information for anyone exploring the crypto markets. You won't understand everything on this page right now, but as we go through this course, it will become more and more clear. We're going to start by scrolling down over here where you can see a list of cryptocurrencies. Bitcoin, Ethereum, Binance Coin, Tether, Solana, Cardano are all different types of tokens. We've expressed that if you go to the middle column, market cap is number of tokens multiplied by the price. You can see the circulating supply of the tokens over here, and you can see the price over here. Market cap is simply circulating supply times the price. You can see Bitcoin has the biggest market cap. Now, if we scroll back up to the top of the page, you can actually see the market cap of crypto as a whole, and you can see the dominance of Bitcoin as a percentage of that market cap. So the total market cap is about 3 trillion, and Bitcoin comprises 43.2% of that. This will change over time, and I cannot wait to look back on this video and see this market cap as far larger. Now we're going to get a crash course on what these market caps mean, how assets with different market caps tend to behave in the crypto market. The first asset we need to understand is Bitcoin. You can see Bitcoin has the biggest market cap, and right now it has 43.2% of the total market. Now, assets with larger market caps tend to be less volatile and generally safer investments. Less volatile means the price goes up less and it also comes down less relative to other assets in the market. Generally safer refers to the fact that the larger coins with more market cap tend to have been around longer or have some key reason for why their market cap is so high, and are less likely to be scams than a coin that is much lower in market cap. As we go down this list, you'll see riskier and riskier assets. So working through the tiers, the next ones that we need to be aware of are the majors. These are roughly the top 10 by market cap. When the price of Bitcoin, when the price of an asset that holds so much of the market goes up, the whole market tends to go up with it. When Bitcoin goes down, the whole market tends to go down with it. Now, the majors are a smaller, less powerful version of Bitcoin. Sometimes, for example, if the price of Ethereum goes up a lot, this can have a significant impact on the rest of the market. Not as much as Bitcoin, but still very significant. Similarly, other coins in the top 10 can do really well, even if Bitcoin is going up or down aggressively, because they are large enough and mature enough to have their own mini ecosystems. Now, oftentimes when Bitcoin goes sideways, it can become a great time to trade these top 10 majors, and all of this will become clearer over time, and I'll show you how to do this in later videos. I'll be showing you how to create your own watch list so you can pay attention to all of these assets and create unique strategies for each of them. So we have Bitcoin, generally the largest and the least volatile. When it goes up, the market goes up with it. When it goes down, the market goes down with it. Then we have the majors, the top 10s. These are similar to Bitcoin. Sometimes they can push the market up by themselves, not always, and sometimes they can go up and down irregardless of what Bitcoin is doing. Now we have the large caps, the top 10 to 20. These are going to be much riskier than Bitcoin and the majors, but they're also going to be much more volatile. Generally, when an asset gets to this range, there's a specific reason it's done. And now as we go down the list, you're going to see a very clear pattern. The smaller the coin gets, the more volatile and risky it is. Risk and volatility is not inherently bad. However, once we go past the large caps and we reach the mid caps, which are the top 50 coins, or the small caps, which are the top 100, or even the micro caps, which are the top 100 plus, we run into major liquidity issues. Now, most people who are watching the course right now won't fully understand what liquidity is, but basically all you need to know is that it becomes very difficult to trade any significant position size. And now we're going to put all of this information together in very important information, the money flow cycle. Normally it takes new traders 6 to 12 months to really get any sort of understanding of this, but you're going to have the unique edge of going into the market knowing how it behaves. First, fiat currencies. What are fiat currencies? Fiat currencies are basically the normal money that you use day to day. These could be US dollars, Great British Pound, euros, whatever your local currency is. So the money flow cycle starts with fiat. Now, fiat will funnel into normally Bitcoin. Bitcoin is the first thing people hear of. It's the best known cryptocurrency and normally the gateway drug into the market. Now, why would fiat go into Bitcoin? Think about this on a macro level. You see the market going up. You see your friend bought some Bitcoin for $100 and now it's worth $500. You want in on that action. You think, hey, what if I put 1,000 in and that goes to $5,000? This is how the masses tend to behave. And they start funneling their money into Bitcoin. This creates a domino effect and the price starts pumping. Eventually though, it gets to the point where, I don't know, someone maybe got in at $10,000, but the price is now $60,000. If your friend bought for $10,000, is now up 6x on his investment, you might not want to do the same thing. And you think, okay, what's similar to Bitcoin? What also has the potential to do this? And maybe now you discover Ethereum or some other large cap, Binance coin, and you think, well, if Bitcoin did well, this one might do well as well. You do a little bit of research, it sounds exciting, and you funnel your money into that. And after you funnel your money into that, this time it pumps even harder because Bitcoin went 6x. And now this asset, which has a much smaller market cap, that means it takes less money for the price to go up more, will give you a 10 or 20x. And suddenly the $100 or $500 you invested has gone up to $5,000. And this effect is also very common. If someone invests a small amount of money and makes a lot, you feel FOMO, fear of missing out. You feel left out and you want to go into the market even harder. And now you've made even greater multiples than the person who initially went into Bitcoin. So people who see you do that are going to be even more inclined to dive deep into the market. And you even get the same effect that the people who went 6x on Bitcoin are now thinking, wait a second, I've been in Bitcoin this whole time, while these assets have been going 20x, why don't I throw my money into that? So both new money and money from Bitcoin flows into these large caps, and you get that same domino effect where the price starts exploding. And then as the success stories fly into the market, as people get more and more greedy, both in pursuit of easy money and this reinforcement that they are geniuses and that they're making really correct decisions, and that's why they're making money. From the large caps, people seek out even more risk. They want to make even more money. That's where they find the mid caps, the smaller coins that will go 100x, 200x. They start funneling their money into those. But the thing is, these sorts of pumps, these sorts of increases in price are very unsustainable. So as the money flows into mid and low caps, this part of the cycle is a lot shorter. You get explosive action, coins going 1000x, absolutely absurd returns, but the party ends just as quickly. Everything starts dumping down aggressively as people either take profit or accept their losses, and that money then flows back into Bitcoin, and thus the cycle completes itself. It goes from Bitcoin to large caps to mid caps and then flows right back into Bitcoin. Now, in the last 5 years that I've been in crypto, I have seen this happen time and time again, and understanding this can give you a huge edge in the market. It doesn't always repeat in the exact same way. Sometimes it goes from Bitcoin to one small subsection of the large caps, like let's say just the layer 1 projects. If you don't know what layer 1s are, you'll find out later in the course. But this is a small subsection of the large caps. Maybe it's just the exchange tokens, and then it flows into mid caps and low caps. So there are specific nuances and different ways that this can play out. But the core fundamental principles are that people start with the least risky assets and go to the most risky assets. The most risky assets are unsustainable, and therefore they flow back into the least risky assets until that cycle ends and crypto as a whole no longer pumps, and that's when the money flows back into fiat. Now, this applies to every single market. This information is timeless, except one thing you need to pay attention to, and that is Bitcoin. Right now, and for the past 5 years, Bitcoin has been the top asset. It has been the one that determines how the market moves. Maybe over time, if people are hopefully watching this in 5 to 10 years, Bitcoin may no longer be the top coin, and that may just be the super large cap coins. Now, there are hundreds of cryptocurrencies out there, but for this video, we're going to hone in on the key cryptocurrencies you need to start off understanding to build up that baseline of knowledge. Bitcoin is digital gold. It's a great store of value, and it is what started all of this off. In today's assignment, there'll be reading materials to find out more about Bitcoin, but for this video, we don't need to dive into the exact tech behind it. Just know it's a store of value and it's digital gold. Next, we have Ethereum. Ethereum was the next big thing after Bitcoin. What Ethereum did is enable the creation of decentralized applications. This is like a new type of internet. Because of its ability to do that, it is highly, highly valued. It was the first layer 1. Again, these might be slightly confusing terms, but you will learn all of them throughout this course. There are other coins like Ethereum as well. The next category of coins I want you guys to be familiar with are exchange tokens. Binance Coin and FTX token, BNB and FTT. These coins are exchange tokens. These are tokens made by exchanges that give you specific utilities on these exchanges, like discounted fees. Now, there are so many other categories of coins, from gaming coins to decentralized finance coins, decentralized exchanges, borrowing and lending. You can find loads of them out there, and over the course of your crypto career, you will encounter loads of these, and you'll find the ones you're most interested in, the ones you want to trade, and we'll teach you how to create your own personalized watch lists as well. Now, the last category I want to cover in today's video are stable coins. These are essential for anyone touching crypto to understand. Two examples of stablecoins, USDC and USDT. These are coins that are pegged to their fiat or government-issued counterparts. In case you haven't guessed already, USDC coin and Tether, USDT, are pegged to the US dollar. 1 USDC equals 1 USDT, which equals 1 US dollar. Now, there are concerns about whether or not these coins are actually backed by the dollars, but I've been using them for the last 5 years and personally am very comfortable in them. Do your own research and find out for yourself how you want to approach stablecoins. But with the extra risk does come reward. There is a lot of convenience in using stablecoins. There is a lot of financial reward as well for interacting with the crypto space using these stablecoins. Key terminology that you need to understand going into this course. We're going to set a baseline and you'll pick up more and more throughout. Bull. You need to know what a bull is because I'm going to use the word bull and bullish a lot. A bull is associated with going up. It's the price going up. Anytime you hear the word bull, think going up. A bullish candle is a candle where it goes up or implies the price is going to go up. A bullish trader is a trader that's betting on the price going up. A bullish market is a market in which the price is probably going to go up. A bullish sentiment is a sentiment that the price is going to go up. Now we have the opposite of that, bear. Bears are associated with the price going down. Every example I just gave applies to bear as well. A bearish market is a market where the price goes down and so on. Finally, I want you to understand what a trend is. A trend is a general direction in which something is developing or changing. In a market, you will have an uptrend, a downtrend, or consolidation, a sideways trend. Market goes up, down, or sideways. A bit more key terminology I want you to understand as we go into this. Firstly, volume. Volume is the number of tokens transacted every single day. If something is popular, it's going to trade back and forth a lot. If it's less popular or less relevant in the market, it's not going to trade back and forth a lot. Volatility is the rate at which the price increases or decreases over a particular period of time. Basically means how much does the price go up and how much does it go down in short periods of time. Finally, we mentioned liquidity earlier. Liquidity refers to the ease at which an asset can be converted into cash without affecting its market price. That last bit is extremely important, without affecting its market price. For example, if I were to buy $10 million of Bitcoin right now, it probably wouldn't impact the price too much. If I were to buy $10 million of a coin in the top 40 to 50, that would have a much more significant impact on the price, moving it up or down. If any of these terms are confusing right now, do not worry. They will be reinforced and repeated again and again throughout this course. The next part we're going to cover is key terminology, actually native to Crypto Twitter. Crypto Twitter is a useful tool that you can actually use to help gauge market sentiment. A lot of key players share their thoughts on the market over there, and you can get a good gauge of the sentiment, not only listening to their thoughts, but seeing the reaction of the market. Let me give you an example. Sometimes when I post an idea for a trade or a sentiment I have, and I see everyone disagree with me, it actually makes me more likely to take that trade, because I found that when everyone agrees with an idea I have, chances are that's a crowded trade and I'm not going to make money. We spoke about this in the previous lesson. One of the best ways to move in this market is to be an outlier. Try to do what others aren't. First term, WGMI. We're going to make it. This is a term used by bulls, people who are bullish on crypto, because they know, we know, that we're going to make it. What is it? It can be what you want it to be. Next, NGMI. This is said to someone who's probably not going to make it, often a bear. For example, if I post a trade idea and everyone comments under it, NGMI, I might be more bullish on that trade idea. HSFP. Have fun staying poor. Now, this is not a dig at poor people, but rather an endearing term that we use to inform people that their actions may result in a situation where they'll have to learn to have fun staying poor. Finally, HSBAF. Holy shit, bears are This section was a little bit of fun because CT culture is extremely important to me and something I think is genuinely a very useful tool to anyone's trading. I want to leave you with something to think about, an idea that I hope everyone can take away, not just from this course, but from their entire trading career. A fundamental understanding of supply and demand can be applied to any market. For example, if you understand how to trade crypto, how supply and demand interact with each other, and you want to start a business in property, trading watches, dealing in rare art, whatever it is, it all relies on supply and demand. These are the core principles of any market. Supply refers to how much there is. If there's a lot of an item, it's easier to get. And therefore, if demand increases, it's very easy for people to get access to this item, so it affects the price less. If supply gets reduced, any increase in demand will result in a drastic increase in price. Demand. How much do people want it? people want something more and it's hard to get a hold of, the price is going to go up. What makes it hard to get a hold of? Reduced supply. Let me share an example that'll help explain this further. Why are Patek Philippe watches skyrocketing in value while Hublots struggle to hold their own in the market? Now, they're both very reputable brands with beautiful watches. The only key difference between the two, outside of subjective aesthetic opinions, is the fact that Patek Philippe have a very limited supply of their watches. That means after they sell all their watches, if there is demand for it, the only way for someone to get a hold of it is to pay someone more money for it. Because if I bought the watch at shop value, I think it's worth that, so I want to wear this watch. Now, if you want this watch, you're going to have to pay me more than I think it's worth, and that creates a cycle of price increasing. Hublots, on the other hand, there's a huge abundance of them. So if I see you wearing the watch and I like it and I want to buy it, I can just go to the store and get it for the same price. That is how demand and supply interact with each other. Sometimes people manipulate demand and supply deliberately. I mean, marketing, for example. Any product that gets marketed, the point of marketing is to increase perceived demand for that product. Another example would be the diamond market. There is actually an enormous supply of diamonds out there in the world, but because very select few companies control this supply, they make sure to drip feed it into the market, therefore creating artificially small supply that results in an increase in price because the demand is pretty high for them. And the final example, let's bring it back to what this course is about. Why has Bitcoin gone up over time? Well, the supply is limited to 21 million. There can never be more than 21 million Bitcoin. But the demand, the global adoption is continuously increasing. Countries all over the world want to own Bitcoin. More and more stores and merchants are accepting Bitcoin. Increased demand, limited supply results in an increased price. And there you have it. In this lesson, we've covered the key participants in the market: buyers, sellers, and brokers. We've gone over the key cryptocurrencies you need to know about. I've explained to you the money flow cycle. This, alongside supply and demand, are the most important things I want you to take away from this lesson and make sure you understand thoroughly. Then we've also explained some key terminology, plus had some fun with terms you need to know. Now remember, to get a written episode summary, a PDF of everything we just covered, to get extra assignments and readings that will complement what you've learned in this course, follow the link in the description below to our Telegram. It will all be posted there. I'm looking forward to seeing you in our next lesson, where I show you how to read trading charts and explain the fundamentals of price action.